Into a critical message recently articulated by the Bank of Canada, which has garnered considerable attention. In a notable speech, Deputy Governor Carolyn Rogers addressed many vital issues, explicitly cautioning policymakers about the potential pitfalls of implementing drastic changes to the mortgage rules to enhance housing affordability. At first glance, this advice may seem somewhat contradictory, especially considering the Bank of Canada's previous actions. During the pandemic, the institution made crucial choices to reduce mortgage rates to almost zero, which helped spark a remarkable surge in housing market. Although this strategy appeared advantageous at the time, it ultimately led to a soar in housing prices, which excluded numerous Canadians from housing market. The consequences of these decisions and the obstacles we face moving forward are central to our conversation today. However, the bank's warning came as Ottawa implements a new mortgage rules. The key changes include extending the amortization period to 30 years for first-time buyers and raising the cap to ensure that mortgages to 1.5 million. Today we will break down the Deputy Governor's remarks, highlighting key points from her recent fireside chat and discuss the impact of the upcoming U.S. policy shift, especially in the light of the recently political changes. If you're ready, let's dive in. First, let's clarify recent discussion about mortgage renewals. Last month, Royal LePage CEO Phil Soper suggested on Bloomberg that we are nearing the end of a renewal wave or pandemic-era mortgages. This means many homeowners will face newer, higher rates by the end of 2024. We have discussed this on the channel before, and it's clear that Sopa's statement did not tell the whole story. According to the bank, more than 4 million mortgages in Canada, about 60% of all outstanding ones, are set to renew over the next 2 years, many of which have not seen the rate increase since 2022. Now let's discuss the main points of the Governor General's speech. She warned that extending mortgage amortization, while it may slightly reduce monthly payments, significantly increase long-term interest costs for the borrowers. For instance, extending a mortgage from 25 years to 30 years can save a borrower about $200 per month, but it will also add roughly $50,000 in interest over the life of the loan. The Deputy Governor emphasized that these longer amortizations not only increase the cost but also heighten the risk for both borrowers and lenders. If a borrower experiences financial stress, they will have less equity to rely on, which could lead to a higher default risk. Now you might wonder why this should matter to anyone. Well, if borrowers and lenders make no more risk than risks ultimately spill over in the broader economy, lenders may respond by requiring more capital to protect against defaults, and investors could start demanding higher returns due to the increasing risk. The results, higher costs, which often trickle down to the borrowers through higher interest rates. The Deputy Governor's speech made a bold and unapologetic statement regarding the accountability of the government, showcasing a willingness to confront issues head-on. In a noteworthy moment, she openly challenged Justin Trudeau, the Prime Minister's controversial 30-year mortgage policy. This direct critique is particularly significant as it represents a departure from the Bank of Canada usually stands to maintain a distance from the government's dealings. The bank typically refrains from delving into the political matters, so her remarks underscore a crucial shift. By taking this public position, the Bank of Canada is not just voicing an opinion, it's sending a robust message to the government. It indicates that apparent readiness to vocalize concerns if they believe that the government policies may jeopardize their obligations, especially overseeing monetary policies related to the housing market. This bold engagement may foster a deeper dialogue about the implications of government policies on economic stability and banks' essential role in safeguarding monetary integrity. Looking ahead, we must consider the significant implications of the recent political changes occurring in the United States. These developments will likely prompt the Bank of Canada to make a strategic adjustment to the evolving economic landscape south of the border. For example, if the U.S. experiences elevated inflation, This scenario would result in increased bond and yields, which in turn would directly influence mortgage rates in Canada. If the trend of rising US bond yields persists, Canadians may face higher fixed mortgage rates. This situation could create a compelling scenario where the Bank of Canada might feel compelled to decrease variable mortgage rates further. Such a move would encourage consumer borrowing and ultimately foster economic growth across the nation. Analyzing these interconnected factors all allows us to appreciate the complex dynamics and the potential impact on the Canadian financial landscape. This approach has inherited risks that must be addressed. If the Bank of Canada lowers its interest rates excessively to boost the borrowing, it may lead to precautious circumstance for those holding variable rate mortgages. These borrowers could face significant challenges when the rates eventually increase, which is likely to occur. Therefore, Canadians navigating these complexities of variable rate mortgages, it becomes imperative to stay vigilant and closely monitor developments in the bond market and policy changes in the United States. These elements can profoundly impact borrowing costs and ultimately influence the financial well-being of variable rate mortgages. Understanding this dynamic is critical to making informed decisions in fluctuation economic landscape. The bank's message also has another important layer. It cautions Canadians who are considering housing as an investment. With the prices surging in recent years, many Canadians have increasingly relied on the property as their primary means of wealth building. If interest rates change for the market suffers another step, declining individuals heavily invested in real estate may encounter financial difficulties. This is particularly relevant as we look at the broader economic challenges that lie ahead within Canada and internationally. To conclude, while these new mortgage rules may aim to make housing more affordable, they might also risk without genuinely solving the affordability crisis. We'll continue tracking these developments on this channel, especially any changes from the Bank of Canada and impacts from the US. Thank you for watching and stay tuned for more latest in the housing and financing. Please leave your comments and tell us what you think of this whole mess. Will that solve your problem or make it even worse for you?